Well then, without further ado, I will stop my screen share and welcome Andrew Brandt and Gloria Gott, Thrivent Financial. What I love about these guys is, unlike a lot of folks out there, they have both sides of the picture, the full picture. They're looking at financial planning and wealth management, but they're incorporating real estate into that picture. And so obviously we all incorporate real estate into our financial planning as well. Both Andrew and Gloria have various real estate endeavors, and both of them work in Boise sometimes and in other places other times. Gloria at Twin Falls is her second office or first, and then Andrew's is Washington. But guys, let me turn it over to you, welcome you, and let you finish the introductions.
Thank you, Stacy. I operate primarily, my main physical base is out of Western Washington, but we float all over between Washington, Idaho, Montana, Utah, and in Oregon a little bit. I've been with Thrivent now for just over 10 years. I'm a certified financial planner. Gloria, I think is it 5 years now going on? Mm-hmm. Man, time flies when you're having fun. And we're gonna jump into the presentation because we have a lot of content kind of compacted in. We're gonna try to get through it all as quickly as possible so we can allow time for questions. So without further ado, Gloria, why don't you kick us off?
Okay, thank you. And we tried to prepare something for everyone. We wanted to leave a little nugget for everyone, regardless of the stage that you're in. If you're in wealth accumulation phase still, or if you're starting to distribute some of that wealth. So we're going to go through some financial foundations. Key thing to keep in mind with our lens, like Stacy mentioned, we believe in diversification. So we don't believe in, one bucket being your only bucket. So there's lots of different ways to build your strategies. These should be individual. But really the lens that we look at portfolios is through the lens of how successful folks are doing this. The name of the game is diversification. It always has been, it always will be. And here's why, because there's a certain level of uncertainty about life. And I think, the pandemic really shone a lot of light on that, but there's a certain level of items that are completely outside of our control. Not to give anyone heartburn, but of course, inflation, right? That's an example that's outside of our control. Taxes outside of our control. Interest rates and what impacts that has on your bond portfolio, your real estate portfolios, those we don't get to control. We don't get to pick which markets are hot for real estate, whether we're in a seller's market, a buyer's market. We don't get to pick stock market fluctuations. The name of the game is spread your risk and have a smart place to get money no matter what happens. So that's the lens in which we're going to share some things for you. We also believe that having a good plan is understanding that there's going to be significant life events that could occur, but they happen to all of us. And we don't know when those will happen, if we live a long, healthy life or not a long, healthy life, right? There's a lot of different variables. So we're going to go through kind of rapid fire. We've been getting a lot of questions about FIRE lately and what FIRE actually is. So there's some of you on the call that may be already retired, but essentially this is a accelerated retirement plan where you can have your independence and retire early. So maybe you're seeking independence from Social Security income and beating inflation, et cetera, et cetera. But here's how Investopedia would define this. They put it in 3 different categories, and it's based on lifestyle and what you want to do. So there's the lean, which runs lean now and plans to run lean later on. There's the fat, which is a little bit more indulgent. You want to have fun now and you want to spend your money now. Maybe you're traveling, maybe you're seeing your grandkids, maybe you're still buying properties, et cetera, and you plan to keep doing that later. Maybe you're more of a fat FIRE model. And then there's somewhere in between called the barista, but we like to call it the hybrid because it's kind of smack in the middle. So we want you to kind of be aware of who you are or who you want to be, no matter where you are on your journey. And so the first target we want you to think about in your investment planning, your portfolio planning, is what type of investor are you? What kind of lifestyle do you actually strive for? So we would want you to think about your desired annual income. And from the FIRE model, that looks like, are you fat, lean, or barista? Some folks will say, I don't really know what I desire. We hear that question a lot. So we would say, if you don't know what your income that you desire is, look at your income now, and then calculate 80% of your income now. That's a good starting point. But for other people, what we hear is once you retire, I mean, they go into a go-go phase where they're going everywhere. They're going. Then they enter a phase later on where they're slowing down. And then you enter your last stage, which is you're not going, right? You're just not going very much. So you can use the model of what it takes to run your lifestyle now and calculate that and use 100% of your lifestyle. Because keep in mind, once you begin to free up your time, you're actually going to have a lot more Saturdays in your schedule. And for some of you who've already loosened your schedule at the office, you know what I'm talking about. There's a lot more freedom, and we tend to spend money on those days. That's just how it works. So your first target is, what kind of desired income do you want? Target number 2, sketch this out, and you can kind of take some notes, look at this through the lens of what are those guaranteed income sources. So we want you to be aware of this because your Social Security, and if you're lucky enough to have pensions, those are going to pipe through like a steady stream of cash. And we want to look at those like what you're building with your property income. So we believe that those are dependable. Now, of course, there's some nuances in how dependable are they really. That's where, tuning into groups like this can make that really dependable for you on your property income. But we essentially want to take all those steady streams of income and calculate them, and that becomes a lump total. Now, side note, some of you have probably already calculated Social Security, probably already drawing that, but just, statistically, this is $1 million decision for a lot of households. So if you are on the cusp of drawing Social Security, or if you've run numbers and you're trying to make that decision, we would encourage you reach out to professionals. That is something we do. You can also reach out to other folks that you may know in the industry. Do not take that without understanding what you're doing, because it is once you take it, it's pretty set in stone. So that's a big impact to your plan. Once you've got those 2 targets, what your desired income is and what you already have coming in from guaranteed income streams, we're going to go further into that and dive into what your gap is. Andrew, why don't you walk us through that?
Yeah, this is.
Before you guys do, let me throw in a question in this transition point and see if anybody else has any questions as well. The first thing that came to mind question-wise, Gloria, is that was very great and interesting. And when you said that taking Social Security is a $1 million decision, I instantly thought to myself, what's the right answer? Do you find yourself advising more people to take it late, more to take it early, or is it literally 100% unique?
It's very unique, and here's why, because we actually look at different things like longevity in your personal health. We look at your health, we look at your family's health, we'll look at whose Social Security is higher. So if you're looking at a married couple, we'll really try to leverage which one we could take first. So it's so individualized, because for some folks, it makes sense to take it early because they're going to delay drawing income from their investments, or they're still ramping up income for real estate. And so they may need it on the front end, but for other people, we can kick it down the road and get those guaranteed increases of Social Security. But it really depends on longevity. So if someone comes to us and says, look, people in my family live to be 92, and that's, just the average, and I want to retire early and I want to retire at 55, we have to be thinking about the long haul, because we truly need all of their money to work in their favor. We don't want somebody running out of money, right? And so we have sophisticated software that actually breaks that down, and we can toggle through and say, what if your longevity is this? What if you take it at this point? How are we tiering in other income streams? It's very sophisticated, actually. But a lot of folks don't realize how sophisticated and complex it could be.
Well, thank you for that answer. That was great. Other questions?
I'll throw in a quick answer to a question that hasn't been asked that might be on somebody's mind. There's been a lot of the news, over the past several years, but it's gotten a lot more play over the last few years. Is Social Security even going to be there? I've heard it's bankrupt. There's no more money in it. And back in 1985, we had some cuts to Social Security benefits and tax increases. And the Social Security Administration at that time said we have about 50 years of solvency. And they were pretty much spot on the money up until the pandemic. And it was about 2034, 2035 where we'd be okay, but we'd have to take some action and probably have some tax increases. With the pandemic, that basically forwarded that a year because of some of the legislation that was passed and relief that was passed. They didn't collect as much Social Security taxes, but Social Security is really easy fix. Currently, I think the first $132,000 of taxable income is actually, you only pay Social Security taxes on that. So you could lift that and make that basically endless, and or post Social Security age longer, and as well as just flat out increase the tax rate in itself. It's a pretty easy fix, but we'll see what happens in Washington over the next decade.
Great addition. Thank you.
Welcome. So next, target number 3, really kind of figuring out what is the gap. What do we need to have by our desired retirement age in the form of, filling the gap of the income that we want. And we're just going to look at a kind of a simplistic example. You can get very specific with this, but in a couple that needs $80,000 a year, that's their income goal for retirement. They have $40,000 in guaranteed income sources, whether that be their rental properties, their Social Security, or maybe they have a pension, maybe they were a teacher. But the point is they need to fill that $40,000 gap. Now, you might look at that and say, okay, I want to add an investment or add a piece to my real estate portfolio as a part of my retirement income stream. That's great. Work with the professional of your choice to really who hones in on that and really can help you kind of project out what will that income actually look like, how much will you really be able to net cash flow and really spend in your retirement. And then after that, then you might want to think about, how do I create some more diversification? And we're going to look at some investment portfolios, but we kind of want to bring to your attention, not everybody knows about this rule. It's called the 4% rule. Basically, what that is when you get to retirement, you can predictably, not always, it's not guaranteed, but you can safely pull 4% off of your investment portfolio, and that should be able to last you in perpetuity. If you want to be more conservative, we say use like a 3 or 3.5%, because that just means you're going to need to save more. And then it's pretty easy. We can just show this real quick. Come over here and you can look at an investment calculator. This is from smartasset.com, but you can basically just go to Google and search investment calculator, and you can figure it out. You can pick how many years do I need to grow this money, or when is my retirement date? Is it 10 years from now, 25 years from now? And then you can come out here, pick your rate of return. We picked a moderately aggressive portfolio, 7.5% average annual return. Work with an advisor to figure out what's suitable and what makes sense for you. And then from there, it's kind of plug and play. And in this case, a couple needs to save $1,200 a month into those investment accounts and retirement accounts to get to that $1 million if they're earning an average of 7.5% over the next 25 years. But it's really easy to plug and play. If you want to come in here and you can get really specific, it's really pretty interesting. And
that's how you solve for the gap using that strategy, is what you just explained, Andrew?
Yes. Yep. Using traditional, using the stock market, using retirement accounts, non-qualified accounts, which we'll talk a little bit more in depth. But yeah, that's how you can kind of really start to hone in, and what do I actually need to start doing every single month today so I can get where I want to be. So next, Gloria is going to touch on some investment accounts, and why don't you take it, Gloria?
Yep. So one of the headwinds that is could be coming our way. I mean, I'm not saying that I have a crystal ball that I can predict the future, but I wanted to show you kind of the overall trend. What's on your screen right now is a trend of taxes. So the gold bars, starting on your left, on your left, are taxes in the past. And as we work our way towards the current, you can see that the trend for those has gone down. We actually have, some discussion. There's a lot of deep discussion happening. The Secure Act, there's a lot of tax changes that impacted people who are investors. And a lot of this impacts when you change hands of something you own and you leave that on, and maybe you're going to leave some of your retirement, properties to somebody in your family. The IRS has made a lot of shifts in that. So if you haven't been informed on that recently, it's a really good time to meet with a professional and ask them what changes of taxes have occurred. But here's why we may have a headwind. If you look at that black tracing that goes up to the right, and you can see it kind of goes up in a stark swoop, that is actually our spending. It's our national debt. So if you look at one trend line goes down, the other has gone straight up. We want you to just be aware, tax efficiency, if you're not already looking at that in your portfolio and your real estate, you're going to want to, because at some point in the future, the question you need to ask yourself is, are taxes going to stay the same in the future, or are they going to go up or go down? And the most successful people have options no matter what taxes do. So if taxes stay the same, you need to have a plan. If they go up or down, you need to have a plan. That's the mantra. So we often see that people are not maximizing their tax bracket. We won't go into that, but a lot of people say, why is my accountant not telling me that I should be doing these moves, or it's time to, shift something from a tax later to a tax never again category? Accountants don't typically do that. They focus on the here and now, or they'll look at next year, maybe most. We have sophisticated software that we can actually tell you, is it time to do maybe Roth conversions on an investment account that maybe you had an old 401k tax deferred? Is it time to do a Roth conversion and wipe that clean of taxes and do something different with that money? We can actually dial that in and look at ways of giving the IRS crumbs of your wealth instead of big bite-sized chunks. Okay, so that's the first thing. Now, if you're still in accumulation phase and you're looking for ways to reduce taxes, there's different ways to do that. There's 3 different buckets. Go ahead and advance the slide, Andrew. 3 different buckets on how things are taxed. The IRS looks at investments as we're either going to tax you here and now this year, we're going to tax you later, or we're going to tax you never again. That's the 3 categories they look at all things with. A couple things that you can do with investments. There's a couple options that you can run through your business. We're not going to cover those tonight, but if you have questions, catch us offline. Traditional IRA and Roth IRA are some of the ways you can move money into an investment vehicle. You can invest it to the appropriateness of your situation. You don't have to be an aggressive investor to do this, but traditional IRAs let you take a tax deduction. Money goes in, you get your tax deduction on your taxes, and you just know that as that account grows, you're not going to get taxed year after year. When you pull that money out, that's when you see taxes. You're sharing that with Uncle Sam, but it could help in years where you just make a lot of money and you're surprised by that. Now, there's limitations around who can contribute based on your age, and also how much money you're making. So you can actually waive yourself the deduction if you're not careful. But again, those are questions to run through your accountant with. The other piece to keep in mind is tax never again. These are accounts like Roth IRA. Some of you are eligible for those. Some of you might make too much money and you would need to look at a backdoor Roth. But a Roth works this way. You pay the taxes on the outside. The money goes into the investment vehicle. It grows and grows. And as it grows, it's all yours. So whatever your value is in your Roth is yours to keep. You paid the IRS on the outside, and so they're not going to have their hand in your cookie jar when you go to pull the money out. Some people will, in retirement before 59 and a half, these come in handy because you can access the money you've put in without penalty. And there's certain situations you can access your gains before 59 and a half without penalty too. But a lot of folks like this because with potential for rising taxes, we don't know, if you have $200,000 saved in your traditional IRA, it's not all yours. You have 200,000 saved in a Roth, it's yours. And so it's a little bit of more peace of mind. You feel like you're in the driver's seat. So those would be things to take a look at if you haven't done that already. Andrew, why don't you tell us about the third bucket, the tax now?
Yes. Before I jump right into that, I want to make just kind of a public service announcement. As we looked at, taxes are pretty historically low. And right now we're working with a lot of clients that have these traditional 401ks, traditional IRAs, to actually look at paying more taxes now. and getting that Roth IRA moved over to the Roth IRA so that from this day forward, they never have to pay taxes on any of the growth ever again. And the current tax cuts that we are in are set to expire at 2025, and then they will go back up to where they were just about 5 years ago. And so that's something you want to be aware of is taxes, as the law is written right now, are scheduled to go back up. So now is the opportunity, if you want to look at paying some more taxes, you want to be mindful of where you are in your brackets, whether you're in the 12, 22, 24, so on and so forth. But it's actually something that a lot of people should be looking at, and it's a huge opportunity missed.
Any limitation to Roth IRA?
I'm sorry, say that again.
Any limitation to Roth IRA? Can be 500,000, million, 10 million, anything? Or
If you have a bunch of traditional IRA money already, there's no limit on how much you can convert. As far as every year contributing into, the limit is $6,000 per year if you're under 50. If you're over 50, you get a catch up of additional 1,000, so for 7,000 total. Yeah. But it's kind of one of those things, the earlier you start compound interest, to have $1 million that's completely yours and tax-free sounds pretty nice.
Thank you.
You're welcome. The last bucket we're going to talk about is just traditional non-qualified or non-retirement account investing. When you hold those investments for over a year, you get that preferential long-term capital gains tax treatment, which is 15% currently. If you have a higher income, you could have an additional Medicare surcharge tax on any of those gains, which would be 3.8%. That's kind of a con to that investment strategy. But as far as somebody maybe trying to retire 50 or 55, maybe 10 or 15 years, or five or 10 years prior to being able to access those retirement accounts, because there's that penalty before 59 and a half. That's a way to create instant liquidity where you can basically live off that money until you get into your over 59 and a half, and then into Social Security age, and so on and so forth. So next, I think we're gonna tap into just a few planning topics that are often not thought of, or they kind of get left on by the wayside, but we think they deserve an honorable mention whenever you're creating a retirement or an investing strategy. Gloria?
So the first one is probably going to affect, it affects everyone a little bit differently based on your age. So take this with a grain of salt based on where you are in your life. Life insurance is a key piece to protect as you're building your FIRE plan. So as you're building your wealth, essentially we see a lot of people get term life insurance in place. What that's there for is to say, if something happens, if you're a business owner and you're the primary reason that money's coming in through your doors to your household, if something happens to you, what happens to that? What happens to the money coming in? What happens to the plan? So often this is something to think through about your particular family situation. If you have a spouse, if you have kids, and people are relying on the income you bring in while you're still building that plan out and building your wealth, you may just want to do yourself a favor, get a little bit of protection in place. It helps give that peace of mind if something was to happen to you. We get a lot of questions about, do I need it because of my age, or this is my circumstance, do I need it? Those are key questions to answer as an individual, because finding the right amount is important. You don't want to have too much, and you don't necessarily want to have not enough either, but you need to understand the purpose of why you have it, right? So it could be just, to pay for funeral expenses and provide liquidity to your spouse so that they don't have to sell off a property if things end up in probate, right? For example. So some of those types of things, it's important to think through for your family and that promise that you can leave to them. The next thing is more about you yourself. It's not about your family as much, but it does impact your family. If you are still in building phase, or if your business requires you to be there, to be the brains of the operation, or be in the thick of it to bring in the revenue, you want to think through protecting your own asset, or your most valuable asset, that we would argue is not properties you own. It's actually you, the business owner. Without you, the engine doesn't run. So one of the things you can do is you can protect your ability to earn an income. You can protect your own revenue that you produce that comes through the door. You can protect about 2/3 of it. And how this works is if you're not able to work because you're ill or injured, there's a certain period of time that goes by and paycheck comes to you. So it kind of helps to have a predictable cash flow if the unforeseen was to happen, but it also protects those savings accounts. So if your plan is not to spend down your savings, but to grow your fire assets or grow your wealth, you know, you want to protect some of that and make that your first line of defense. So those are some things to think about if you're still in building phase. Andrew, why don't you take us through the last two that have more to do with health?
Yeah, the next one should be obvious, but I can't tell you, we still see so often people are retiring early and they are walking around like without health insurance, for example. And it's just a major, major risk to your retirement plan. You know, I don't care how you build your wealth, whether it's through real estate or stocks or bonds or whatever. If you're going to retire at say 50, you have to have that plan in place that we're going to need health insurance. You know, a married couple can easily spend $1,000 a month on health insurance premiums and, you know, have 15 years of insurance premiums before they can get on Medicare at age 65. That's $180,000 that has to be accounted for. And that's where the hybrid fire kind of comes into play. That's where someone might work part-time just enough to get those health insurance benefits, but then, you know, still have lots of time to do the things that they want to be doing. But definitely health insurance has to be factored in. Lastly, kind of towards the end of life, end of retirement, we're getting really, really good at keeping people alive a really long time and keeping people healthy a long time too. In this country, the fastest age demographic that is growing in America is the over age 90 demographic. So there's a high likelihood if you're walking into retirement when you're, you know, 55, 60, 65, and you're relatively healthy, there's a very, very strong chance that you will live past age 90. And one thing we haven't solved for is, what if I become frail and I need some help, right? What if I need some long-term care? That is really important to plan when you're creating your fire strategy or your retirement plan, because that is one thing that can ultimately just knock everything that you've worked your life building. And there are ways to protect against that, you know, but the importance is having a plan. There's long-term care insurance out there. You can develop a self-pay strategy. The important place or the important piece is you have to have a plan. Otherwise, everything that you own is totally up for grabs. I've experienced it in my own family where I saw my grandparents go through, you know, $1.5 million of liquid assets, and then they went through about $700,000 of real estate, and then it was all gone. There's nothing left. And part of the problem was they didn't have the ability to plan for that because it's kind of a newer thing. But it's really important you have a plan. That's where we stress that there's no one right way to plan. Every situation is different, but having a plan is extremely important because I think we all want to be able to pass on that wealth that we've built rather than just having it dwindle away like dust in the wind. No pun intended with that one, by the way. We're here to help. If you would like to sit down with us and over Zoom or in person and just, you know, have a conversation for a half hour, 45 minutes, get to know each other, get to know your situation, what you're looking help with, we're more than happy to be around. And I think we're going to take questions. Is that right, Stacy? If there are any.
Yeah, let's do some Q&A. Everybody, if you want to jot down their information, also their Andrew and Gloria's email was on the invitation. They were at the top CC'd, and you can reach out to me and I'll connect you guys. And with that said, Andrew, you can stop the screen share if you want. And I know I'll start it off. I had a burning question. Any thoughts on how we can plan for what our income should be in terms of rising costs and inflation? How does that fit into our fire strategies?
That's one really challenging piece because we're in a very, worst inflation we've seen in more than 4 decades. And we think it's going to eventually come down, but no anybody's guess. I would say use, if we take a zoomed out view, inflation has been just over 3% on average per year over the last 100 years. So I feel comfortable. We usually use the 3 to 3.5% inflation rate on our need every month or every year, and that will give you a pretty high number of what you need in terms of future dollars. If the longer you go out, it's going to need a lot of money. But if you want to be more conservative, you can use a higher inflation rate. I wouldn't use anything probably higher than 4%, just because we also haven't had much inflation over the past decade up until recently. So that's something to take into account as well.
And so in the example that you gave, somebody wanted maybe 80,000 a year, I think, with what they wanted. Do you know, roughly speaking, what that would look like when you start to apply inflation?
If we'd use like a 3% inflation, it would probably, in 25 years, it'd probably be double that.
Okay. So when we're looking at what we need, we can talk to you guys and you'll help plug it in, or we can also assume that the inflation is going to be a significant impact on that initial starting number.
Yeah, we have software that actually maps all that out and then actually gives us a Monte Carlo analysis where we have different rates of return on investments and inflation rates to kind of give us an idea of, how successful am I going to be in my retirement based off of 1,000 different possible scenarios. Again, that's why we're big believers in having real estate as a part of your portfolio. It creates diversification that is a great hedge with inflation.
Yeah, that was kind of my question. Your timing was great. So in the conservative profile, what's your weighting on real estate versus stock bonds versus fixed income, et cetera?
Right now, we're very equity heavy. We're very overweight in domestic stocks right now, but we're going to probably be turning towards international very soon here because they have just gotten rocked over the past year, but also specifically in the last 60 days.
Okay, and what weighting do you put on the real estate side? 20%, 50, 90?
Are you talking about in a broad portfolio, like a personal portfolio?
Correct.
So yeah, that's I don't think there's a problem with, let me put it this way. If you say, hey, I want to be able to have $6,000 a month just to live my daily life, my personal philosophy with retirement planning is, if my goal is to have that $6,000 a month guaranteed, or what I would call close to guaranteed, coming in every month. And that's through all our guaranteed income sources. So if that means you're going to fund $6,000 a month through cash flow through real estate, I think that's great because that's a predictable, reliable income coming in every single month in retirement. They've actually studied people in retirement. The people that live the longest are not the people with the most money. They're the people with high guaranteed income streams, whether it be rentals, whether it be pensions, whether it be annuity incomes, but they tend to live the longest in retirement, not the people with the most money. And so I want as much guaranteed of my need, what do I need to live, as much as possible. Then the rest, then I can be really aggressive with the rest of my portfolio. I can make, maybe I can make a more speculative real estate investment or traditional stock market investment if I want to. Does that help?
Yeah, it does. Thank you.
You're welcome.
I don't know if this question is too blunt, but what do you guys charge? Do you charge by the hour or by the package, or how does it work?
Yeah, we normally sit down and just have a conversation, figure out what do you need help with, and then we just build a proposal from there. It kind of depends on what you want help with. Like a typical retirement plan, like means testing your retirement plan, some estate planning, getting some of those things work, working with your CPA possibly, or your estate planning attorney. A typical retirement plan is somewhere around $2,400. Does that give you some idea?
Yeah, sure. Now, I have another
And
question.
I think,
I thought I heard you say that you could take a traditional IRA, an unlimited amount of traditional IRA, and convert it over to a Roth. Did I miss, is that correct?
You can. Will have to pay the taxes on whatever you convert. And so
And you
that's
have
where
to-
you want to be careful.
And you have to stay within the 8,000 per year limit?
With a conversion, the IRS doesn't care. In fact, they would love it if you converted all of it at once, because you'd attach, say you had $250,000 in an IRA, you're attaching $250,000 of taxable income to your 1040. They would love that because you're going to pay at a much higher tax rate. So that's where we want to stay. Like, if you're in the bottom of the 22% bracket, you can fill up the entire 22% bracket, but you probably don't want to go into the 24% bracket. So you want to be very cautious in how you convert, how much you convert. We like to convert towards the end of the year, because what if something comes up and you need to take a distribution from that IRA? We don't want to go back and try to unconvert it, at last minute.
That's a good
Great.
question. I think Jim had a question as well.
Yeah.
Jim and Nancy, I thought I saw.
He's muted.
Jim, you're on mute. If you want to ask a question on the bottom of your screen, I think is the unmute on the bottom left. Otherwise, we won't be able to hear you. There's Nancy. There we go.
Can you hear me now? Can you hear? Okay.
Yes.
My question is, can you use the 1031 exchange tool to go from selling a residential property and invest in a real estate investment trust?
No, because it's not like to like. That'd be a tough sell.
Okay.
If you're gonna get into a real estate investment trust, I would say make sure you look at the fine details. If it is not a publicly traded REIT, be very, very cautious. Those non-traded or actively traded on exchanges REITs, they are riddled with all different exclusions. You often can't get your money out when you want to. It's a nightmare for a lot of people. So be careful, read the fine print. And you got to really make sure you understand what you're getting invested in. If it's not on the stock market, the attraction is, we pay a 8, 9, 10, 12% internal rate of return. But oftentimes that doesn't end up being the case, and or you can't get your money out altogether. And advisors who sell those get 10 to 15% commissions. There's a reason why they get 10 to 15%. They're hard to sell because a lot of people don't want to get
In
in.
other words, you're saying that there's a lot of risk involved.
I'm saying do your homework, do your due diligence, and read the fine print.
I'll have to get some magnifying glasses, I guess, then.
Yeah, you definitely, it's worth the money to go out and get it, and so you can read it, because it's just important to know how you can get your money out when you want to. It's not like you have a piece of real estate that maybe it's paid off and you can go get a line of credit pretty easily in a few weeks, right? Whereas the real estate investment trust, some of them, you have to wait several years before you can get your money, or you basically get pennies on the dollar back.
What happens if you invest and both spouses, the husband and wife, pass over the river? What happens to the principal that you invested? Where does that go?
That's in your fine print. that's another thing. I've seen it where the kids can't get at the money right away. They have to wait until the next redemption period. And then the value can still fluctuate. So that there's no guarantee with a real estate investment trust that you're even going to get your principal back.
Oh,
Good to know.
well, I appreciate your frankness and the honesty there. I don't want to have to chase you down and say, you told me so.
I don't ever want to hear that from anybody. So yeah, just
Okay.
be very careful with those.
All right, I appreciate your help, sir.
You're
Thank you.
welcome.
Thank you.
Good question, Jim. I'm glad you asked that.
I won't
Perhaps
charge
this
you for it.
question is too big. This question might be too big, but I have 5 properties. I'm approaching retirement age, and I need to, I need an exit strategy with these properties because I've been self-managing in almost every way and just can't keep that up forever. And so what are your thoughts around that scenario?
Ooh, Gloria, do you want to tackle it or do you want me?
Well, I think let's let you tackle it. I think, Bobby, I just want to say one thing, evaluate your bandwidth of time, right? If you wanted, what pieces that you want to continue to do versus delegate out. But I think there's probably some good contacts that Stacy also knows, but Andrew, go ahead and share your thoughts too.
Yeah, I think the first question is, do you maybe want to give up the management? That's something, or, give up the management and pay someone else to do it, and investigate what that cost is and what your net bottom line ends up being is really important. If it's worth it to you and you get what you want and now you don't have to worry, that's a pretty great strategy in my opinion. And, I even do that now. I have a property that I don't self-manage. I pay to have someone else do it because I don't want the stress or the thought in my head. But if it is a situation where maybe you are going to liquidate some or all, that's where I would say it's definitely time to get people involved, get a financial planner involved, get an accountant involved, and get a real estate agent involved, because those 3 combined are going to be your team to manage the taxes, because you're not going to want to sell 2 in 1 year, especially if you've been depreciating them. It's really going to want to understand what are the tax impacts of liquidating each property and when you do it.
So is that something your company helps with, or is that something that the CPA and the or you all as the financial planner would be helpful part of that team?
That would be kind of a trio team. So that would be like us, Stacy, and a CPA, and really understanding, what is the strategy, because, the real estate agent and the CPA are going to help kind of more on the front end with, okay, I sell this property for this price. Here's my tax liability. Then what's left over? Okay, how does this fit into your retirement plan? And how do we make it work for you? How do we make sure that, your money outlives you and not the other way around?
And Bobby, on that note, it's kind of fun because it was great to hear Gloria and Andrew's start to answer your question, because I had the same exact thought. One of the biggest things that sometimes inspires people that controls the timing of how long you hold real estate is when it's not professionally managed, it can just be a pain. And you may be doing a better job, but you can still do that job, but have your manager do the work. You can still be an asset manager, take an active role, pay attention to what your property manager is doing, drive by and call the person who's your property manager and tell them that the tenants at the single family home didn't disconnect their hose bib and it's getting cold outside. You can still make sure those things happen. But man, that self-management, that self-management can take time, and it doesn't always until it does. But I just don't think that is the number one factor that should make or break how long you hold and how long you sell, when you sell. And so I love it that all 3 of us independently kind of started with that. And so, so I wanted to be the third to echo that. because I also gave up that job. I did it for a while and I just got tired of it and hired it out. And I'm glad I did. And I still
Great.
check my hose bids. And the year I didn't, I had a hose freeze, and that was $100, you know, and 8% is that number I might budget. You could go lower. I don't think that what percentage should be the first question you ask your property manager when you're screening them. And if any of you do take that step to hiring a property manager, I have a checklist of 12 questions that I could give you that you should ask all property managers. And if they come in lower than 8%, fine. 10% would be the high, but I don't think that the price should be the number one factor in choosing them.
Yep. And just to add one more thing, I completely echo Stacy. So there's a lot of the work that we do, people ask, what's the bottom line? Talk about the money. There's a trade-off with all things in life. We manage our wealth, you know, a lot of us for a reason. There's a reason we want a better lifestyle. So we don't oftentimes look at, we want to accumulate things so that we can just stay busy with those things and then not live our life. And so we end up seeing that people go through a paradigm shift of it's about the money and it's about keeping our money, our hard-earned money in our pocket. But there's a transfer of freeing up your time that there's no price tag for that. And so that's one of the things that we try to lead you in discussions about how do you want to spend your time, because that is as crucial as how you manage your money. I mean, it's two. You are your time, and you're not promised tomorrow. So if there's something that you haven't had fun your whole life and you just are waiting for tomorrow to do it, you know, there comes a tipping point where we have to nudge our clients and say, the time is now. You're not enjoying life. It's time to free up your time to do some of these things you want to do, which may mean that you have to offload some of this responsibility onto someone you trust. And it's not, you know, there's no magic day that happens, but it's more of a conversation and a collaboration, if you will, about what's right for person A versus person B.
Great point, Gloria. Really great point. I want to do a summary before too much time goes on. Does anyone have any other burning questions, or would it be okay if we went into that kind of a little recap here?
Stacy, this is Tom. I just want to comment to the person who just asked a question about property management. I've been using a property management for 12 years. And on top, I don't live in Idaho, right? I'm in Michigan. So, and it's been a success. So all I can say to the woman that asked the question, it's a very valid way to move forward, and I would highly recommend it.
Thank you.
Appreciate the input, Tom. Okay. Well, I think what I'll do is let me leave this off. Thanks to AVID Investors for being here tonight. Thank you so much to Gloria Gott and Andrew Brandt of Thrivent Financial. We have heard some amazing things tonight. I believe there's a lot of nuggets that you've left us with your presentation, and I took some notes and wanted to run through a couple of them. And you can cap me off if there's any super duper highlights I've missed. But when we're looking at FIRE, financially independent, retire early, and or figuring out when it is time that we can either let go of our primary source of income, get into side hustles, or let go of all income together, there's really three major factors in the equation that we need to look at, and then a bunch of considerations. But the factors are income. What are your income needs? And then secondly, what are your sources of income? If you think you're going to need 80% to 100% of your income that you have now, find what is that number and what is your current sustainable ongoing income bringing in, your rents, your Social Security, your dividends, and then fill the gap. Because if there is a balance to fill, you can look at what you're doing with your money right now and figure out how to fill that gap, where to put it, and actually plug in the numbers so that you can literally fill the gap. And when you are determining your number, there's a few ways of doing it. You can go lean, you can go hybrid, and you can go fat. Does this investment strategy make my butt look big? However you want to live, that's up to you. But in any event, things are going to happen. You're going to have taxes are going to change. They could go up. There could be inflation. And 3.5%, 3%, that's a number you might plug in backwards plan to figure out what that income need is when you want to live fat or lean or hybrid, and figure out how that translates back today. And with it all, there's some other things you can look at, which is your IRAs, converting into Roth, and making sure that Uncle Sam doesn't get more of the pie than he has to. That's what I heard tonight. You guys, what did I leave off on the major highlights from what you've given us, this wealth of information you wealth planners have shared with us today?
I'll just chime in, get a team surrounding you. You can't make, the best people don't make it alone. I mean, that's number one, the other part. But also have somebody, if you haven't done it already, stress test your plan for the things that are outside of your control. They should be able to stress test the plan and say, this is a liability. Do you want to address that liability? And this is how big that liability is. And so I would say that those partners you pick should be able to stress test those plans and bring new ideas. So those would be the other key pieces. You covered a good recap, Stacy. Thanks.
Great. Well, this has been so helpful. Andrew, anything to add on your end?
Yeah, work with your financial planner. If you don't have one, you can reach out to us. Look for tax opportunities that you can leverage now and over the next couple of years before taxes go up.
Yeah, that 2025 year was interesting. We're going to lose some tax cuts in 2025, Andrew told us today, among the many golden nuggets. And well, thank you all, AVID investors. Thank you so much for being here tonight. I hope this has been helpful to all of you. And if there's any last minute questions, this is the time to ask them. Otherwise, we will call it a wrap.
Stacy, I have a suggestion. This is a free webinar we're doing. We can open it up and probably save 4 or 5 spots. We have a complex planning session that's coming up the 22nd and the 23rd. It's one of our advisors from New York. It's going to be covering complex, more sophisticated planning. This is not like the things that we covered today. A lot of it is legacy planning and disinheriting the IRS, those types of things. I'll go ahead and send you the link. So if anyone wants to kind of sign up, we just probably need to manage it to about 4 or 5 people signing up, because we don't have unlimited space, but it's called Strategies.
Okay, and if anyone wants to hit me up for that or information on any of this stuff tonight, please don't hesitate, and I can connect to everyone. But other than that, thank you so much, Gloria. Thank you, Andrew. That was really helpful tonight.
Thank you.
Thanks, AVID investors.
Thank you.
Thanks, Stacy.
Bye.
Bye, guys.
Bye-bye.